Welcome to the weekly combo podcast, where I'll go over the action in the market for the week of July 7th through the 11th, and we'll see how things look for the week of July 14th through the 18th. The stock market showed resilience this week despite some late week fatigue. The S&P 500 dipped slightly on Friday, down 0.31%, but the major indexes, including the NASDAQ 100, and NYSE, hit all-time highs throughout the week. Mid-caps and small caps, however, gave back gains on Friday, reflecting some uneven performance. Trading volume remains below average, which is typical for the summer slowdown. Growth sectors, including tech and communication, helped lead the charge, with Nvidia making headlines by surpassing $4 trillion in market cap. Meanwhile, healthcare and financials trailed. The 10-year Treasury yield climbed to 4.41%, nearing the critical 4.5% level, which should be watched. New tariff announcements, 25% on Japan and South Korea, 50% on Brazil, sparked Friday's decline but are largely seen as negotiating tactics, limiting broader market disruption. Early earnings reports are encouraging so far, with 71% of S&P 500 companies beating estimates by an average of 4.6%. However, earnings season is just starting and very few companies have reported. This is also tempered by forward guidance, which suggests caution. The VIX remains below 20, and positive breadth indicators, including new highs and new lows, as well as the advanced decline lines, signal market stability and strength. GDP growth is projected at a steady 2.5% with no immediate recession concerns. The Fed is expected to hold rates steady at its July 30th meeting, with two 25 basis point cuts anticipated by year-end. Moving over to the intermarket analysis update, the S&P 500's high valuation, both historically and looking forward, with a PE ratio of 22.1 and a forward PE ratio of 22, is driven by mega-cap stocks with a lofty PE of 29.1. In contrast, mid-caps at 16.1 and small caps at 15.5 offer relative value but are underperforming. Growth continues to outperform value, reflecting positive market sentiment, though small and mid-cap growth-to-value ratios weakened slightly this week. Some commodities are signaling economic optimism. This includes copper as well as silver, which are strong. Oil is rising, but aluminum, corn, and wheat remain soft. The CRB index's uptrend hints at mild inflationary pressure. Sector-wise, tech and industrials are leading, while staples, real estate, and healthcare are lagging. Bonds are underperforming stocks, with junk bonds outpacing government bonds, and the rising 10-year yield favors stocks over fixed income. The dollar is in a long-term downtrend, but showing a short-term bounce, while the euro, pound, and yen are gaining. Silver is outperforming gold, and the copper-to-gold ratio suggests economic strength. Growth indexes, including the NASDAQ 100 and FANG index, along with semiconductors, hit new highs, and emerging markets and high-leverage loans signal optimism. Interestingly, stocks are correlating positively with oil and yields, an unusual dynamic. While valuations and rising yields warrant caution, the market's tone remains positive. Moving on to the deep dive update, the S&P 500's uptrend is intact, with prices sitting 6.87% above the 200-day moving average. Anchored moving averages provide potential support if there are declines, and the long-term VIX, being below 20 alongside declining volatility ratios, reflects low fear and a preference for stocks. The skew index's drop and an Ulcer index below its moving average further confirm positive sentiment. Cumulative advanced decline lines for the S&P and NYSE are near highs despite low summer volume. Large cap growth ETFs, as well as the NASDAQ 100 or QQQs, lead this week with a score of 78, which is the dominating area of the market, while small and mid caps scoring 41.6 and 42.1 did weaken on Friday. Financial and regional banks remain range-bound, awaiting earnings catalysts by the big banks this week. Bonds and tip ratios suggest low inflation concerns, and a declining 2-year Treasury yield creates a market-friendly environment. Historical data from 2023 and 2024 shows July pullbacks, with August and September often weak. However, the technicals remain bullish, with short and intermediate-term trends above moving averages, but the Special K long-term oscillator continues to be negative, while other indicators, including the Connors RSI and point-and-figure charts, show no major new signals. Global markets are mixed, with the DAX retracing slightly, and U.S. stocks are not yet outperforming globally. Low volatility and strong technicals support the uptrend, but seasonal risks and trade news call for vigilance. Moving on to the What to Watch update. On the positive side, the S&P 500's healthy uptrend, recent golden cross, and all-time highs signal strength. Growth is outperforming value, with tech, semiconductors, and discretionary sectors leading. Rising risk-on, high beta, and S&P to utilities ratios, along with the smart money indicators, including accumulation distribution, the Chaikin money flow, and oscillator, point to continued optimism. Broad market indexes, including the NASDAQ and Wilshire 5000, are positive, and stocks are outperforming bonds, which suggests a soft landing with no recession in sight. On the cautionary side, below average volume while making new highs, a fear and greed index at 75, and a declining McClellan oscillator signal potential overbought conditions. Weakness in financials and a weekly mass index signal align with historical July pullback seen in 2023 and 2024. Areas to watch in the upcoming week: earnings. Bank earnings could help set the tone for the financials as well as the broader market. Yields. Watch the 10-year yield nearing 4.5%. A breach could pressure stocks. Trade news. Tariff developments may shift sentiment if perceived as significant. Jobless claims. Rising continuing claims nearing 2 million signal potential unemployment concerns. Oil and the dollar. Rising oil and a bouncing dollar from oversold levels bear monitoring. Historical patterns. Mid-July pullbacks in 2023 and 2024 raise caution for 2025. In summary, strong trends and growth-driven indicators outweigh the negatives, but low volume, elevated sentiment, and trade news suggest staying vigilant for potential pullbacks, especially given recent seasonal patterns. The outlook for July 14th through the 18th? The market remains constructive, driven by growth sectors, but faces risks from rising yields, particularly if the 10-year breaks above 4.5%, tariff developments, and potential profit-taking due to high sentiment. Earnings, especially from banks, will be pivotal in setting the tone. Historically, the second half of July is positive but underperforms the first half of July, so caution is warranted despite the positive trends. Keep an eye on the financials and small caps for sign of strength or further weakness. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.